Hey guys, Oleg Tkach here with NFM Lending, and I want to take some time out of today and just kind of explain what happened with interest rates and what's going on with interest rates. There's a lot of confusion right now in the marketplace, and what are they? What happened? What is the federal government cutting rates by 0.5% yesterday on Sunday mean to us and everything else? So to explain it, what I want to do is I want to share a screen here, a chart that we watch pretty much daily. So here we go, sharing it now. So you should be seeing a screen here of what's known as the bond market, the 10-year Treasury bond market, which is actually what impacts interest rates above everything else. And so this has a direct impact on what happens to interest rates and what they are daily. So if you look here, just to kind of show you this graph and to explain it to you, this shows different days. So you see here, this is in December, and then we're going into January, and then February, and then March, and then now here we are today. And so every candlestick, which is what they're called here, shows a different day in the market. So when the bond market actually increases, when it goes up, rates come down, and when the bond market goes down, decreases, rates go up. And so if you look here in December, you could see that rates were slowly getting better, then they stabilized, and then they got better again in January, and then they stabilized here in February. And then all of a sudden, with coronavirus and everything going on in the marketplace, with the emergency rate cut that happened back in February, you see rates got all of a sudden significantly better. And up until this is Monday, and there's what's it called, alert to lock here on Monday. So Monday, end of day, something happened that we've never seen happen before, and I'll explain it. So with coronavirus and everything going on, what you have is you have banks, like for example, Bank of America, Chase, all your big banks where people deposit their money at. And so what happened is all these people in preparation for the unknown and everything shutting down, went to the banks and they're withdrawing cash. And banks are only required to have 10% of their deposits on hand. The rest is invested into home loans, business loans, and different investments that they do. And part of the investments that they do is they buy bonds, which is what we have here that controls rates. And so what happened is all of a sudden, all these banks, all these consumers are demanding cash. And because they're demanding cash, banks have to sell off pretty much their mortgage bonds to be more liquid, to be able to give the cash back to people that are demanding them. Essentially, there's a run on the bank. And so what happened is we saw out of nowhere, unexpectedly, rates in the 3-day period. This is Tuesday, Wednesday, Thursday. We pretty much lost, as you could see, the bond market going down, meaning rates going up. In a 3-day period, it was the largest loss to the rate market that we've ever seen. And so what happened is in this 3-day period, rates went up, by about 1.25% to 1.5%, depending on the product, from Monday night to pretty much Thursday. And so, of course, this is completely unexpected. No one knows what's going on. Some of you might have heard it from a lender or seen it, but the media is not talking about it. And some of you that have spoken to me, we've told you about it. And so basically what we all expected in the mortgage industry is for the Fed to act, which is what they did on Sunday. And as soon as they did that, this is Friday where we saw the market stabilize a little bit. But if you look here, this is when you're pretty much in the high 3s range right here, whereas, in the low 4s. Whereas when you go back up before rates crash, so to speak, in a bad way, over here is when you had the low 3s or in some cases high 2s, depending on the program and everything else. So the Fed responds, they do an emergency rate cut to stop rates from continuing to go up. Now, a lot of people have reached out and said, well, rates 0.25% or 0.5%. And that's like, no, what the Fed changed was the federal funds rate which is the overnight lending rate that they give to banks. And so it was 0.75 on Friday. Now it's from 0 to 0.25%. So banks now could borrow money at a cheaper rate to be able to then, lend it out and to also, give it to the people that are, requesting it, withdrawals from their deposit accounts. So anyway, they do this on Sunday, and look, all of a sudden what happens, which is today, we are up what's 159 basis points, the largest increase I've personally ever seen in a day, and I've been in the business for 15 years. And so we've seen this reverse back to where the Feds pretty much are stopping the rise of rates and trying to get them back down to the levels that they were before last week, which, again, completely unexpected. So for those people that locked around here and up around here before everything crashed last week, you're safe, you're good, rates are not any better, you shouldn't do anything. The people that missed the boat in locking, which a lot of people did, a lot of lenders just stopped accepting locks altogether, and so if you during this period of time missed it, rates are coming back. They're coming back down. And over the next week, over the next 2 weeks, we expect to see them back to the levels that they were prior to, you could say the bond market crashing because of banks selling off at a massive pace. Also, the reserve requirements that the Fed requires from the banks is you have to hold 10% of your deposits. They actually also changed that. A lot of people don't realize it, but they changed that on Sunday as well to where 0% of your deposits are being held. And again, they're trying to do this so that way banks don't continue to sell off their mortgage bonds and rates don't go up and hurt the housing market. So anyway, there you have it. That's pretty much what happened. And so we hope over the next few weeks, rates will come back down. If you're somebody thinking about refinancing or your clients are calling you about refinancing, what we're doing is we're having our clients send us a mortgage statement to our email. And my email is Oleg, OLEG, at NFM Lending. .com. And so we're holding on to their mortgage statement, their information. They can also apply online. And as soon as rates return, we're going to reach out to them. We're going to get them lock ready, and we're going to lock them in when the opportunity arises. If you are working with a buyer that didn't lock, tell them not to panic. Rates are going to come back down. It's okay if they're floating, which is what most people are doing right now while they're waiting for rates to return back to normal levels. And that's what we're doing with some of our contracts that we got in last week is we're floating, meaning we're not locking them in, and we're going to lock them in when times get better. So anyway, I just wanted to share that with all you guys. So you could share that with your clients or your friends or your family, whoever it is that's watching this video, just so that way they know what happened with interest rates and the why behind the rate cut this Sunday. So anyway, thank you for watching. If you have any questions, reach out to me and my team. We could be reached on my cell phone at 425-478-7676.